Welcome to Boring Metals, it's your John AG. The CME Group announced a margin hike on silver futures at exactly 2 p.m. Eastern on January 30th, 2026. 48 hours earlier, they'd already raised margins once. And here's what Wall Street doesn't want you to understand. By the time that announcement hit, over $2 billion in silver paper contracts had already been dumped into the market. Gold crashed 9%. Silver nosedived 30% in a single trading session, the biggest one-day collapse since March 1980. You blinked and trillions in precious metals value just evaporated into thin air. But here's the part that keeps me up at night. This wasn't random. This wasn't organic selling. This was mechanical. This was engineered. And if you think this story ends with Friday's bloodbath, you're not paying attention to what's happening right now in the COMEX vaults, in the physical markets, and in the quiet corners where smart money positions itself before the crowd even knows the game has changed. Stay with me because there's one signal hiding in plain sight that could decide everything. Today is February 2nd, 2026, and I'm going to do two things for you in the next 25 minutes. Thing number one, I'm breaking down exactly what happened in the silver and gold markets over the last 72 hours. Not the headlines, not the surface level panic. The actual mechanics of how a margin hike announcement turned into the fastest wealth transfer we've seen in precious metals in over 4 decades. Thing number two, I'm connecting this to the bigger macro setup that nobody's talking about yet. The supply deficit that hasn't gone anywhere, the physical shortage that's still real, the central bank buying that continues behind the curtain, and most importantly, where this market goes from here and what that means for your positioning right now. If you get value from this kind of breakdown, hit subscribe. It helps more than you think. I don't do clickbait. I don't do hype. I do mechanics and probabilities. This is not about headlines. This is about understanding how markets actually move and where the next inflection point sits. Because here's what I know. Everyone's focused on the crash. Smart money is focused on what comes after the crash. Now let's talk about what's actually happening in the silver market, because this is where people are getting the story completely wrong. On Thursday morning, January 29th, silver hit an all-time record high of $122 per ounce. Gold touched $5,600. The rally had been building for months. Central banks stacking gold. Industrial demand for silver running hot. Deficits stacking year after year. Then Friday happened. At 2 p.m. Eastern, the CME Group issued a margin hike announcement. Silver maintenance margins jumped from 11% to 15%. Gold went from 6% to 8%. Platinum, palladium, copper, all hiked. But here's the critical detail everyone's missing. This was the second margin increase in 3 days. The first hike came quietly earlier that week. The second one hit right before the weekend, which meant anyone holding positions over Saturday and Sunday would need significantly higher collateral by Monday's open. That created a forced liquidation event in the final 2 hours of Friday trading. Traders who couldn't meet the new margin requirements had no choice but to dump contracts into a thin market. And when you dump into a thin market, prices don't decline. They collapse. Silver dropped from $121 to $85 in a matter of hours. That's a 30% intraday move. The biggest single-day percentage drop in silver since the Hunt Brothers crisis of 1980. Gold fell from $5,300 to below $5,000. A 9% crash, the fastest one-day decline in over a decade. Spot gold today sits around $4,600. Silver's hovering near $80. Now, here's the first cliffhanger. The CME didn't just raise margins because of volatility. They raised them twice in 72 hours, and the second announcement came at the exact time of day when liquidity is thinnest and forced liquidation creates maximum damage. That's not risk management. That's market structure warfare. And if you think that was accidental, you haven't been paying attention to how these games work. Now let's talk about the supply side, because this is where people get lazy and miss the entire point. Everyone's focused on the price crash. Nobody's asking why silver hit 122 in the first place. Let me give you the numbers. Global silver mine production has been essentially flat for 4 years. We're producing roughly 820 million ounces annually. That number isn't growing. It's declining in real terms when you adjust for ore grade deterioration. Most silver, about 70%, comes as a byproduct of copper, lead, and zinc mining. That means primary silver miners can't just ramp up production when prices spike. They're structurally constrained by the economics of base metals. On the demand side, we've got a problem that's not going away. Industrial demand for silver is growing because of solar panels, EVs, electronics, and 5G infrastructure. The Silver Institute projects that 2025 marked the 5th consecutive year of supply deficit. 2026 is on track to be the 6th. That's 6 straight years where demand exceeds supply. When you run a deficit for 6 years, you drain inventory. And we've seen exactly that. COMEX registered silver, the stuff that's actually available for delivery, sits at 105 million ounces as of last week. That's down from over 300 million ounces just a few years ago. Shanghai gold exchange vaults are reportedly being drained. London Bullion Market Association inventories are tight. And yet, the paper market on Friday acted like there's infinite supply. Here's the leaky bucket metaphor. Imagine you've got a bucket with a hole in the bottom. Every year, the hole gets a little bigger. That's industrial demand growing. The water coming in from the top stays the same. That's mine production stagnating. At some point, the bucket runs dry. We're not there yet, but we're closer than most people realize. The price spike to 122 wasn't speculation. It was the market beginning to price in that structural reality. And the crash? That was leverage getting flushed out. But the fundamentals that drove the rally haven't changed. The deficit is still there. The inventory drain is still happening. The demand isn't going away. Comment what time you're watching this right now. I read those, and it helps me understand who's paying attention. Now, quick history lesson because cycles rhyme, they don't repeat. Let's go back to 1980. The Hunt brothers tried to corner the silver market. Prices exploded from $6 to $50 in a matter of months. Then, on March 27, 1980, the COMEX changed margin requirements mid-game. Silver crashed from $21 to $11 in a single session. The Hunt brothers were liquidated. Fortunes evaporated. That was a manipulation event designed to break a corner. Fast forward to 2011. Silver ran from $18 to $49 in the span of 4 months. Then came the margin hikes. 5 increases in 8 days. Silver collapsed back to $30 within weeks. Everyone screamed manipulation. The mechanics were the same. Leverage gets extended, margins get hiked, forced liquidation cascades, prices crater. Now here's 2026. Silver ran from $28 in early 2025 to $122 by late January 2026. That's a 330% move in just over a year. The biggest bull run in silver history. Then came the margin hikes, twice in 3 days. And the collapse mirrored 1980 and 2011 almost perfectly. Here's the pattern. Every major silver rally in modern history has ended with a violent deleveraging event triggered by exchange rule changes. But here's what's different this time. In 1980, there was no supply deficit. In 2011, the deficit was small and short-lived. In 2026, we're 6 years deep into structural undersupply with no sign of it reversing. The crash looks similar. The underlying fundamentals are completely different. In 1980 and 2011, the spikes were driven by speculation and crowd mania. In 2026, the rally was driven by central banks, industrial demand, and a physical market that's genuinely tight. Those previous spikes had one similarity. Crowd belief turned into crowd certainty. Everyone knew silver was going to 100. Everyone knew gold was going to 6,000. And when everyone knows, the trade is over. But here's the second cliffhanger. The difference between a speculative bubble and a structural bull market is what happens after the crash. In a bubble, prices stay low for years. In a structural bull market, the dip gets bought and the uptrend resumes because the fundamentals haven't changed. We're about to find out which one this is. Here's where we separate position building from event chasing. Because if you're sitting there thinking you missed the move, or if you're panicking because you bought near the top, you need to hear this clearly. If you're event chasing, you're vulnerable. The market can smell it. You buy on headlines, you sell on fear, and you get shaken out at exactly the wrong time. Position building means you're okay if price drops tomorrow, because you understand the thesis and you're playing a longer game. You're not over-leveraged. You're not emotionally fragile. You're methodically accumulating when others are scared and trimming when others are greedy. So here are 4 questions you need to ask yourself right now. Question 1. Has the supply deficit been solved? Answer, no. Mine production is still flat. Demand is still growing. The deficit continues. Question 2. Has physical availability improved? Answer, no. COMEX registered inventories are still historically low. Coin dealers are reporting shortages. Premiums on physical silver are spiking even as paper prices crash. That's telling you something. Question 3. Have central banks stopped buying gold? Answer, no. Central bank gold purchases remain robust. They're not selling into this dip. They're steady buyers. That supports the macro case for precious metals. Question 4. Is the crowd still bullish or have they capitulated? Answer, check sentiment. If retail is panicking and dumping, that's often the sign of a bottom forming. If everyone's still euphoric, there's more pain ahead. Right now, sentiment has shifted from euphoria to panic in 72 hours. That's usually not a sell signal. That's usually a buy signal for patient capital. Here's the framework. If you wait until everyone agrees that silver's going back to 150, you're going to be late. The edge is being willing to position when it feels scary, when the headlines are all doom. When people are saying the bull market is over, That's when smart money accumulates, not when CNBC is breathlessly reporting new all-time highs. For deeper analysis on these setups and real-time alerts when I see key levels being tested, check the channel membership link below. That's where I share the granular stuff that doesn't fit in public videos. Now let's get technical for a minute, because charts matter and market structure matters. Before the crash, silver was in a parabolic blow-off phase. Parabolic moves always end badly in the short term. That's not bearish long term, it's just how markets work. You can't go straight up forever without a correction. Gold had broken out above its previous all-time high of 2,100 from 2020 and ran to 5,600. That's a 160% gain in 16 months. Silver's move was even more extreme, from $28 to $122. That's over 300%. Both metals were technically overbought on every time frame. RSI was pinned at the top. Moving averages were stretched, the rubber band was pulled as tight as it could go, then the margin hike snapped it. Now, here's where it gets interesting. Gold has found support around 4,600. That's roughly the level it was trading at in mid-January before the final melt-up. Silver's support appears to be forming near $80, which was the breakout level from early January. If those levels hold, this looks like a healthy correction in an ongoing bull market. If they break, we could see a deeper retracement back to 4,000 for gold and 60 to 70 for silver. From a market structure standpoint, pay attention to the divergence between paper and physical. The paper market crashed. The physical market is showing tightness. Coin dealers are reporting they can't get supply. Premiums on physical silver eagles and bars are exploding. That disconnect tells you the paper market is driven by leverage and liquidation, while the physical market is driven by real supply and demand. When paper and physical diverge like this, the physical market is usually right over the medium term. Paper can be manipulated. Physical can't be printed. Now here's the ratio analysis. The gold to silver ratio spiked from 45 to 1 up to around 57 to 1 during the crash. Historically, when that ratio gets above 60, silver tends to outperform on the rebound. We're not quite there yet, but we're close. If gold holds and silver continues to underperform temporarily, that ratio could hit 65 or 70, which would set up a massive snapback opportunity in silver. Based on the supply deficit, the inventory drawdown, and the technical support levels we're seeing, the math is probability weighted toward gold reaching 6,300 by year end and silver recovering back above 100 within 6 months. That's not a guarantee. That's a probability weighted scenario based on fundamentals and historical patterns. Now let's zoom out to the bigger macro setup, because nothing happens in a vacuum and precious metals are always a reflection of what's happening in the broader financial system. On January 30th, President Trump nominated Kevin Warsh to replace Jerome Powell as Fed chair when Powell's term ends in May. Markets initially read that as hawkish because Warsh was historically known as an inflation hawk. But here's what people are missing. Warsh has recently been advocating for lower rates to stimulate growth. He doesn't believe inflation is the primary concern right now. He's more worried about growth slowing. That should be bullish for precious metals, not bearish. Lower rates mean lower opportunity cost for holding non-yielding assets like gold and silver. Yet the market sold off. Why? Because short-term traders were using it as an excuse to take profits after a parabolic rally. The macro environment hasn't changed. Real rates are still low. The Fed is still in an easing cycle. The dollar had a temporary bounce, but the long-term trend is still dollar weakness as the rest of the world diversifies away from treasuries. China, Russia, and BRICS nations continue to buy gold and settle trade in non-dollar currencies. That's a structural headwind for the dollar and a tailwind for gold. On the inflation front, the PPI report that came out the same day as the crash showed producer prices rising 0.5% month over month, hotter than expected. The core PPI jumped 0.7%. On a year-over-year basis, headline PPI is running at 3% and core is at 3.3%. That's not disinflation. That's inflation reaccelerating. Producers are starting to pass through higher costs from tariffs and currency weakness. That eventually flows into consumer prices. Inflation is the environment where precious metals thrive. Now look at risk assets. Stocks have been wobbly. Credit spreads are widening. Volatility is picking up. When risk-off behavior starts to creep into equities and credit, safe haven assets like gold typically benefit. We saw that dynamic play out from mid-2025 through January 2026. The crash was a leverage flush, not a macro regime change. When you see physical tightness, supply deficits, central bank buying, rising inflation, and a Fed that's easing, that's the recipe for a multi-year precious metals bull market. This doesn't happen overnight, but here's the realistic timeline. Next 3 to 6 months, consolidation and base building in the 4,000 to 5,000 range for gold and 70 to 90 range for silver. 6 to 12 months, resumption of the uptrend as physical tightness reasserts itself and macro concerns intensify. 12 to 24 months, potential for new all-time highs above 6,000 for gold and 150 for silver if the structural deficit continues and fiat currency concerns accelerate. Here's where the edge is, and this is the part most people will ignore because it requires patience and emotional discipline. The overlooked opportunity right now is that Wall Street is treating this like a speculative bubble that popped. They're comparing it to 1980 and calling it a mania. But they're missing the supply side of the equation. They're missing the physical tightness. They're missing the fact that COMEX inventories are at multi-year lows while industrial demand is at multi-year highs. Smart money isn't panicking. Smart money is watching physical premiums. They're watching coin dealer inventory. They're watching whether miners can actually increase production, which they can't in the short term. The asymmetric setup is this. If this was a bubble, prices stay low and fundamentals deteriorate. But if this is a structural bull market, with a temporary deleveraging event, the next leg up happens faster than anyone expects, because the crowd got shaken out at the bottom. What's the crowd missing right now? They're missing the difference between paper liquidation and physical demand. Paper can flush, physical can't be created. When paper flushes and physical stays tight, that's a coiled spring. The crowd is also missing leading indicators. Watch the gold to silver ratio. Watch copper, which is a leading indicator for industrial metals. Watch the dollar index, which has bounced but is still in a longer-term downtrend. Watch Treasury yields. If yields start falling again because growth is slowing, that's rocket fuel for gold. Now, personal psychology check, because this is where most people fail. If you can't handle 3-day dips without panicking and selling, this sector will chew you up. Precious metals are volatile. They whipsaw. They go parabolic, then they crash, then they grind higher again. You need to be willing to look wrong before you look right. You need to have the emotional fortitude to hold through corrections when your thesis hasn't changed. If you bought silver at 100 and it's now at 80, ask yourself, did I buy it because of a supply deficit and industrial demand, or did I buy it because of FOMO? If it was the former, nothing has changed. If it was the latter, you were event chasing and you got hurt. That's the lesson. Energy trades like a heavyweight boxer. It lumbers, feints, then throws a hook when you're not looking. Precious metals trade the same way. Long periods of boring consolidation, then explosive moves that catch everyone off guard. Right now we're in the correction phase after an explosive move. The next explosive move is being set up right now. So what does this mean for you? Let me break it down by timeline because your positioning should match your time horizon. Short term, the next 2 to 4 weeks, here's what to watch. Does gold hold support at 4,300 to 4,600? If yes, that's a sign the correction is over and the next leg begins. If no, we could see a deeper pullback to 4,000 or even 3,800. For silver, watch the $80 level. If it holds, the worst is over. If it breaks, we could retest 70 or even 65. Watch physical premiums. If premiums on coins and bars keep rising even as spot prices fall, that's a massive signal that the paper market is disconnected from reality. Medium term, the next 3 to 6 months, key levels to watch are 5,200 for gold and 100 for silver. If we reclaim those levels, the bull market is definitively back on. The supply deficit will start to reassert itself. Industrial demand won't go away. Solar installations don't stop because silver crashed. EV production doesn't halt. The structural drivers remain. Long term, 6 to 12 months and beyond, the ultimate target is 6,300 to 6,500 for gold and 125 to 150 for silver. Those targets assume the deficit continues, central banks keep buying, and fiat currency concerns escalate. That's the bull case. The bear case is that somehow mine production ramps up significantly, or industrial demand collapses due to a global recession. I don't see either happening in the near term. Risk management. If you're positioning in precious metals, don't use leverage. That's what got people destroyed on Friday. Physical metal can't get margin called. Paper contracts and leveraged ETFs can. If you own the physical metal, you can wait out any paper market nonsense. Position sizing matters. Don't bet the farm on any single asset. Precious metals should be a portion of a diversified portfolio, not the whole thing. What invalidates the thesis? If COMEX inventories start surging back above 200 million ounces, that would suggest supply is coming back online. If central banks start selling instead of buying, that's a red flag. If the dollar enters a new bull market and rallies 20%, that's a headwind for gold and silver. Watch for those signals. They're not here yet, but they're your exit triggers if they show up. Tell me in the comments, do you think silver hits 150 before the end of 2026, or does it pull back to 60 first? I want to hear what you're thinking. Remember what I said at the start. The CME raised margins twice in 72 hours. The second hike came at 2 p.m. on a Friday, forcing weekend liquidation. Over $2 billion in silver paper contracts were dumped. Gold crashed 9%, silver 30%, the biggest one-day drops in decades. But the fundamentals haven't changed. The supply deficit is still real. The physical markets are still tight. The industrial demand isn't going away. Central banks are still buying. Here are the 3 most important data points to focus on going forward. Number 1, COMEX registered silver inventory at 105 million ounces. That's a multi-year low. If that number keeps dropping, the physical squeeze thesis is alive. Number 2, the gold to silver ratio currently near 57. If that pushes above 65, it's historically been a screaming buy signal for silver relative to gold. Number 3, physical premiums on coins and bars. If those stay elevated or keep rising while spot prices are down, that's the market telling you paper and physical have diverged, and physical is the truth. What to watch for next? Early warning indicators include whether the dollar continues its bounce or rolls over, whether Treasury yields keep rising or start falling, and whether stock market volatility picks up or calms down. Key price levels that confirm or deny the thesis. For gold, 4,600 is support and 5,200 is resistance. Break above 5,200 and we're resuming the bull market. Break below 4,300 and we're in a deeper correction. For silver, $80 is the line in the sand. Hold it and we're fine. Break it and we're going lower. Create urgency without panic. The next phase of this cycle won't send you a calendar invite. It won't announce itself with headlines. It'll happen quietly while the crowd is still licking their wounds from Friday's massacre. Positioning happens in the quiet moments, not the loud ones. When everyone's screaming that the bull market is over, that's usually when the next leg is being set up. Markets price consensus, not inevitability. Right now, consensus says the precious metals rally is over. Inevitability, based on supply and demand fundamentals, says otherwise. I'll be tracking COMEX inventory numbers closely over the next few weeks. That's the tell. If those inventories keep dropping while prices consolidate, the spring is coiling tighter. When it releases, it's going to be violent. 3 quick things before you go. Number 1, hit subscribe so you don't miss the next move. I'll be covering every major development in this precious metal story as it unfolds. Number 2, share this breakdown with anyone who's confused about what just happened or wondering what comes next. And drop a comment telling me what you think. Are we at the beginning of a deeper correction, or was Friday's crash a gift for anyone who understands the fundamentals? Number 3, join my premium WhatsApp channel for daily voice notes and instant updates when key levels break or major news hits. Link in description. I send real-time alerts when I see setups developing, so you're not waiting for the next video to know what's happening. And we're doing a giveaway at month's end for subscribers who comment. You're automatically entered just by engaging. This is not financial advice. Do your own research. Consult a qualified professional before making any investment decisions. I'm showing you the mechanics and the probabilities. Your